Thank you, Alexandra. Good morning, afternoon, everyone. I am Taha Amiar. I welcome you very warmly to this online COPTAT session hosted by the Committee of Practice of Clean and Affordable Energy, of which I am the facilitator. This time we'll have a conversation about the role of financial sector in supporting private sector in national determined contribution implementation. The COPCHAT is organized jointly with Deloitte Tomatsu Financial Advisory in Tokyo, Japan. Before giving the floor to our experts, I would like to recall some housekeeping items. Please keep muted your microphones. You can also communicate with us using the chat box. Please send us your comments and questions in advance through the chat box. May I remember that the session is entirely recorded and this will be available later today with the presentation at the link available at the chat box in a few minutes. The question and answer will also be transcribed later in the week. And now I am pleased to present our speakers. We have with us Alexandra Sozer, Climate Change Technical Specialist at UNDP Energy BPS team. We have Raymond Kagioa, Project Manager for Climate Change International Development at Deloitte Tomatsu. We have Samuel Alterescu, Vice President at International Development Advisory at Deloitte Tomatsu. We have Ms. Megumi Sato, Senior Analyst at the International Development Advisory of Deloitte Tomatsu. And last, Mr. Stanislas Day, Head of Structured Products from the Stanbic Bank, Ghana. Now I hand over to my colleague, Alexandra, for her introductory remarks. Thank you.
Thank you very much, Taha. A very warm welcome to our global audience today. We will discuss today how the financial sector can spearhead private sector investment in climate actions in energy, agriculture, and the water sector in selected countries in Africa, Asia, and Latin America. It is well known that the Paris Agreement requires the mobilization of private sector investments to achieve its ambitious targets. Transforming nationally determined contributions, or NDCs, into tangible actions that lead to long-term zero carbon and climate resilient development requires financing. Access to finance is fundamental to realize the objectives set by the NDCs. Through our assessments, we saw that many countries have taken significant steps to enhance the participation of the country's financial institutions in providing financing for key NDC sectors such as energy and agriculture. For example, in Uganda, the Energy Credit Capitalization Company and its development partners are supporting several programs that provide credit support to microfinance deposit-taking institutions, commercial banks, and credit institutions to extend financing of energy solutions. This COPCHAT will outline today how investments in low-carbon technologies face significant barriers from the financial sector due to the real and perceived risks associated with these types of investment. However, commercial banks have shown interest in partnering with international organizations to provide products at an improved interest rate. Blended finance is therefore a potential option for countries' commercial banks and can address the risks perceived by investors as they represent a significant de-risking option for emerging markets through the use of instruments such as guarantees. Recommendations which will be outlined today include how commercial banks could leverage the support extended by international organizations and how blended finance programs could be bundled with capacity building programs aimed at commercial banks so that these banks enhance their willingness to assess business models with which they may not be so experienced or comfortable with. So without any further ado, it's over to our first presenter, Remo from Deloitte.
Thank you very much, Alexandra, and the UNDP team. and welcome to everyone participating in this webinar. So we will be presenting the findings of our NDC private sector engagement project with UNDP, and this is the second in the series of webinars for this project. Today, we aim to address the question, how can the financial sector spearhead private sector investment in climate actions in the energy, agriculture, and water sectors in selected countries in Africa, Asia, and Latin America? So let me start by giving you a quick background regarding our project and present to you our main findings specific to the financial sector. After which I will be handing the floor over to my colleague Samuel, who will present recommendations addressing the findings. Okay, so our project with UNDP is entitled the NDC Private Sector Engagement Project, and it involves the assessment of private sector investment potential for delivering NDC targets in specific sectors across the 7 target countries. Specifically, these are the energy sector for Cote d'Ivoire, Ghana, Kenya, and Uganda, the agriculture sector for Paraguay and Philippines, and the water sector for Tunisia. The project was undertaken through document and literature review involving the examination of the NDCs and national strategies to identify NDC and sectoral targets, and also the identification of enabling environment for private sector participation. The project also involved reaching out directly to relevant key stakeholders to obtain direct information from them. So we held several interviews with the public sector, such as relevant sectoral ministries, government agencies, and regulatory authorities, and relevant private sector stakeholders, such as private sector associations and financial institutions. So from these consultations, we try to understand the current sectoral ecosystem and value chains. We identify the current private sector involvement, identify the available financing, and identify the barriers and challenges that the stakeholder face in implementing climate actions. And based from these, we conducted our assessment and provided recommendations to address the identified barriers and challenges. This webinar is, as I mentioned earlier, is the second in a series of 3 webinars. So for this webinar, we will be presenting the key findings specific to the financial sector, including the financing instruments available for private sector investment and the main barriers in providing green financing, as well as present the recommendations on how the financial sector can spearhead private sector investment in climate actions. After the presentation of findings, we will set aside some time for a quick panel discussion to hear directly from a commercial bank's perspective and also from a country perspective on the barriers and challenges that they are currently facing. So on to the findings. This slide presents an overview of the financial products and services available from the different financial institutions in the assessed countries. So here we can see that debt and some equity products are already being provided, which could be accessed by private sector stakeholders and serve as financing sources for private investments in the energy, agriculture, and water sectors. For commercial banks and institutions providing microfinance, most products are focused on providing loans or debt. However, these generally come with short tenors and high interest rates. So for example, in Uganda, financial products are available for the installation of solar energy systems. For this purpose, you can avail of a loan up to 50 million Uganda shillings, which is around 13,500 US dollars, with a very high interest rate of about 24% and a short tenor of only 5 years. In Cote d'Ivoire, commercial banks provide relatively more affordable rates compared with its neighboring countries, with typical rates ranging from 6 to 10%. However, the short tenors remain a major bottleneck in providing financing to the energy sector in the country. A 7-year tenor is usually defined as a long-term financing in Cote d'Ivoire, but this is still considered relatively short for energy-related projects, and especially very short for infrastructure-related projects. Now, some banks offer more advanced products through the use of securitization and asset company models. Securitization involves pulling various types of contractual debt and selling the cash flows to other investors. This can reduce funding cost and transfer risk. The asset company model involves the creation of two distinct legal entities, the asset company itself and an operating company serving different but complementary functions, allowing the provision of longer tenors and reasonable interest rates to innovative business models. However, providing financing to SMEs and consumer financing remains a challenge. And there is generally a limited supply of equity in the target countries. Venture capitals, private equity funds, and impact investors fill the space. So these investors invest in local companies, providing equity and also some debt financing. For publicly owned banks and development financial institutions, they also provide financing through credit lines, guarantees, project financing, and direct financing. On asset-based financing, it is an important financial service offered in the target countries. It allows consumers to access and use the purchase equipment while repaying a loan. The asset, in this case, the equipment, usually becomes the collateral for the financing institution. In the solar home system space, this is commonly referred to as the pay-as-you-go or pay-go model. And other instruments available to support private investment in climate action includes the use of carbon finance, utilizing revenues that could be generated from the sale of emission reduction units to pay for incremental costs associated with implementing mitigation projects. So next slide. And despite the availability of financial products and services that private players can use for investing in climate actions, there remain key barriers in providing finance from the supply side and accessing finance from the demand side. The key barriers from the supply side include the high risk associated with investments in climate-related solutions and technologies. And as earlier discussed, the lack of long-term financing and the lack of equity. There is also the lack of experience in project financing and also the lack of specific financing directly related to green and climate-related projects. And finally, there is the underlying regulatory issues and the cost of capital. Now, on the demand side, there is a lack of green and climate-related business addressing the sector's concerns. Potential private sector investors generally lack the basic finance and accounting skills to fulfill requirements in accessing the available finance. And lastly, there is the lack of pipeline innovation. While obtaining finance in itself is already a significant challenge, strengthening the investment pipeline to attract potential investors could improve financing conditions. Now, at this point, I think we would benefit to hear directly from the perspective of financial institutions, so particularly from a commercial bank. We have with us right now as a guest panelist, Mr. Stanislaus Day from Stanbic Bank Ghana, who kindly agreed to provide us his views on the barriers for commercial banks in Ghana. So as a first question to Mr. Day, we understand that Stanbic Bank Ghana already provides consumer finance in the energy sector that targets renewable energy, energy efficiency, and clean cooking. We also understand that other banks provide similar financing as well. However, these are still provided at relatively high interest rates with relatively short tenor. So from Stanbic Bank's perspective, what do you think are the main drivers behind the high interest rates being provided to clean, low-carbon technologies, despite the fact that these technologies are already being adopted in Ghana? Stan?
Yeah, thank you very much. the name, is it Raymond?
Yes, it's Raymond.
Oh, okay. The first one I'll have to school before I can pronounce that.
Sure.
Okay, so you rightly put it that there is quite some this level of business that is going on when it comes to the sector, the green sector, the sustainability sector, the climate sector, depending on how you want to call it. But there is still an issue of high interest rates. And basically, I will just try to list some of the reasons. One of the reasons is cost of equity. For most people who wants to invest in renewable energy and other projects in the country, they want to look at the country and look at the risk levels, the inflation, the sovereignty risk, and all that. All put together, there is cost of equity that goes with investment into these projects. So when you look at it, from somewhere 23.4% somewhere last year, now our equity, cost of equity is about 25%. That gives you an average how much cost goes with people wanting to invest in any sector in the country. So that is one of the reasons. Secondly, our cost of funds is still also high in the country. So when you look at our treasury bill rates on the average at 90 days, you are talking about 14% thereabout. What it tells everybody is that there is an alternative investment that you can actually put your money into without necessarily taking additional risk of technologies that you might not be very conversant with. Instead of going into those type of ventures, why don't you put your money with the central bank and make some money there, or put the money into other projects that you fairly understand? So that is another thing. What I can say clearly is that there is no also, what is causing all these things is you realize that there's no clear, what do we call it, taxonomy in terms of green finance in the country for banks. And so people don't really see these projects as projects that they are compelled to go in for. So now we are putting together, a sustainable banking principle, which is going to drive these things. A lot of the financial institutions are not very conversant with this and don't really use the blended finance way of doing things. So if you ask me, there are some technical and risk areas for these projects that they could blend with other funding sources like Green Climate Fund, Climate Investment Fund, and others. And we as banks can also bring in our money to reduce the cost of debt or investments to make these things more affordable for the clients. So I believe the moment we partner more with institutions like yours, with institutions like government, with institutions that can actually bring some alignment or structure around the green financing itself, we should be able to now start seeing rates that actually go with some of these technologies and get people comfortable. We are also looking at situations where we will partner with developers that are in this field to create second or secondary markets for some of these products, because most of these products are asset-based, and there should be no reason why they should be, the interest rate should be that expensive, because you can actually sell this to other customers if anything even happens. So those are some of the reasons why these things the interest rate seems to still be high. But we are working so closely with other development agencies and government to make sure that these things come down. Government, for instance, in recent times gave interest at 12% for some affordable home projects that we are carrying out. So there is possible that we can still relook at some of these rates and make it very comfortable for the clients.
Understood. Okay, thank you very much, Stan, for providing us with your insights on this, and those are very helpful. My second question, and I think you've touched upon this, especially for the supply side, but probably elaborate more and also provide us, just from your view, what could be the potential solution for both the supply side and the demand side to overcome existing barriers that the financing sector face in providing favorable finance for clean technologies?
Okay, so again, for the supply and the demand side of this issue, I think we need government and also the banks in the conversation. So when you look at it critically, there need to be clear climate policy instruments in place from the government side, and also from the bank side. They need to understand how these policies work. So elsewhere, we know that we have two ways of looking at this. You have the command and control systems, and you have market-based instruments that government uses to support or ensure that everybody is engaging in the right type of behavior towards a green economy or sustainable economy, or whichever way we want to call it. What I think is that as we talk today, these policies have not been embedded well enough. So you can talk about regulation and rules that tells people how to take care of water systems, how to take care of air pollution and all that. The moment those conditions are working well in terms of the command and control systems, people are more careful about what they want to do. And institutions also take advantage of these situations to say, if you are doing things right, then we want to support you with this type of reduction in interest rates, because government is saying this is the right behavior and you are doing it well, we want to support you. We have issues like feed-in tariffs, feed-in premiums, grants, guarantees, and all the investment support that government can actually bring out as policy issues. Now, when that is being done well, now banks can also now align with some of these things. So if government is saying that, okay, for people who are into renewable energy, I want to give them a tax incentive or tax relief of so and so percentage because you are investing in these projects. Instantly, that will impact how much even a bank wants to charge on such facilities. And it also provides an incentive because we see the government giving such incentives, it gives more comfort for the banks to also do this. I think the last bit that I want to touch on is the demand side of it, the developers or customers who need this type of funding. The comfort that we want to get, especially for the from the developers, is to make sure that they are dealing with the right type of technology, the quality of the technology, that they understand it themselves, and they have the capacity to put together proposals that are compelling enough for you to say, what the person has put out there, we are able to get back whatever money we are putting in. So there are situations where you have a lot of the developers just jumping into the field of solar energy and all that, put a product out there that now, because of because the quality issues are not right, customers are struggling with those solutions, and then it becomes very difficult for you to even convince clients to go for those products, or now convince banks to invest in those type of projects. So how well they put together their proposal, how good their equipments or products are, is very critical for us to be able to put confidence in those projects. So what we are doing again is listing qualified vendors or developers that bring some of these products to make sure that the right products are being given so we can feel comfortable to support. So that is what I will have to say about that as well.
Great. So thank you very much, Mr. Dave, for sharing your thoughts on the questions raised. And these indeed are very informative, especially hearing from you firsthand. So as we present the recommendations later on, I think we will be hearing from you more. So let's go to the next panelist. Just allow me to change the slide for quickly. Now, from a country perspective, we also have with us as guest panelist Ms. Megumi Sato from Deloitte Japan, who led the study for Kenya. So Ms. Sato, For the first question, can you please provide us some insights on the key barriers faced by commercial financial institutions in Kenya to enhance private sector access to finance?
Yes, thank you, Raymond. So in Kenya, there are a number of financial products that are available to the private sector. However, some subsectors and some type of investment projects in the energy sector, such as large-scale on-grid utility projects and projects in clean cooking subsector, still experience some challenges in accessing adequate financing options from commercial banks. For the on-grid utility scale projects, the lack of access to long-term finance, such as long-term debt and equity, is a key barrier for the private sector due to the perceived risks associated with these types of investments. For the clean cooking subsector, the key barrier to accessing finance for the private sector is the informal nature of the business and the lack of project pipeline and bankable business plans. This subsector is dominated by informal artisanal producers who have limited asset base, production, and growth capacities, which ultimately limit access to formal financing from commercial banks. This informal nature of the business is often perceived as high risk with unattractive return on investment by traditional commercial banks. In addition, in Kenya, in September, okay.
Yes, go ahead.
Sorry. So in addition, in Kenya, in September 2016, an act to cap the interest rate chargeable by the banks at no more than 4% at a base rate was enacted. This measure was intended really to address poor affordability and availability of credit to working entrepreneurs and people. However, while it did benefit some borrowers, such as the government and large corporations, it resulted in unintended consequences of limiting private sector lending, which reduced access to loans for small and medium-sized enterprises, damaging Kenya's overall economic growth. And the cap on interest rate really made banks less willing to lend to SMEs because of the high risk premiums associated with them. However, the government did remove the restriction early this year in 2020, and it is expected that this will help enhance and increase the number of loan approvals provided to the private sector going forward. Thank you.
Yeah, thank you, Megumi, for providing us with your insights on Kenya's commercial financial space. And we have heard earlier from Stan, a commercial bank's perspective on the key constraints in providing financing specifically for renewable energy, energy finance, and clean cooking, which are the main subsectors often targeted for mitigation actions under the NDCs of the focus countries. Now, outside of commercial banking, can you please share with us your thoughts on the other key financial institutions that could play a role in enhancing access to finance of the private sector towards clean, low carbon technologies and solutions, and ultimately contributing to their respective countries' climate targets?
Yes, thank you. So there are other financial institutions aside from commercial banks that are providing access to financing for the private sector in Kenya for the energy sector. These include microfinance institutions, rural banks, savings and credit cooperative societies, and other financial institutions also include impact investors, including venture capital and corporate venture capital investors. These investors invest into companies that are likely to provide more measurable social, economic, and/or environmental benefits in addition to their financial return. And these investors have played a critical role in advancing renewable energy projects and clean cooking in Kenya. Private sector players have also developed innovative business models such as pay-as-you-go or asset-based lending, contributing to enhancing access to financing in the energy sector. There are also crowd investing or crowdfunding platforms that are active in Kenya that offer alternative source of finance. And these crowdfunding platforms support projects in clean cooking subsector, such as in efficient fuel production and cook stove manufacturing, as well as in renewable energy, such as distribution of off-grid solar home systems. Thank you.
Okay, thank you, Megumi. And also, can you please share with us how these other financial institutions contributed to enhancing access to finance for private stakeholders in Kenya?
Sure. So MFIs and rural banks and SACCOs provide consumer financing in the form of debt to SMEs. Impact investors provide financing in the form of equity and debt. Crowdfunding platforms offer finance in the form of donation, microloans, and equity. And these different financial institutions, target specific customers and entrepreneurs and offer flexibility in financing and payment options, which eliminate the barrier to accessing financing. Private sector players that also offer asset-based lending are also more willing to provide financing to unbanked customers who may face challenges in accessing finance from commercial banks. Crowd investing platforms also offer access to financing to earlier stage companies that may require a lower level of financing. And they also provide bridge funding for projects such as in mini-grid market that are expected to receive result-based financing. Crowd investment has played a critical role in Kenya, as minimum loan amount has increased in the country recently, making access to funding more challenging for smaller companies. And it is expected that the use of crowdfunding or investing platforms and this trend will continue as they offer more favorable rates, develop greater risk appetite, and provide better value impact. Thank you.
Thank you very much. And those are very informative. Again, thank you very much to both our panelists, Stan and Megumi, in providing us with very informative perspectives on the barriers that are currently being faced by the financing sector. For the next part of the presentation, please allow me to turn the floor over to my colleague, Samuel, who will share with us some recommendations to address the barriers identified. So over to you, Samuel, and let me turn over the control of the screen to you as well, so you can flip the slides.
Okay, thank you very much, Raymond. So I will now take over for the second part of the webinar as introduced by Raymond, which is related to how can the financial sector actually enhance green financing and financing towards NDC actions. And so this is based, of course, on our findings, but also on discussions with the panelists. So we'll have some more discussions with them. And I would like to focus on this, so we might have to do some time control given the time that is left with us. So moving on to the next slide, which I'm trying to do. The first recommendation is actually related to climate finance. Yes, very good. To blended finance. So blended finance, as you know, is a central topic in our reports. In infrastructure financing, which is really crucial for large-scale energy and water infrastructure, so blended finance can help enabling long-term financing. So you know that infrastructure finance is usually done over 20, 25 years, maybe more sometimes, because those have cash flows over a very long time. But most investors are actually unable to provide long-term financing, as that was emphasized in the first part of the presentation, and have heightened risk perceptions after 5 to 7 years. So it's very hard to finance those. So for those partial risk guarantees, for example, partial credit guarantees, for example, could help, and affordable short-term debt can also help very much. Guarantees can help investors remain committed on the longer term, while providing guarantees on repayments after a number of years can actually help reducing default risk. Reducing cost capital in the first phase of the project is important, because in the first phase of the project, you're basically doing constructions, there are no cash flows. So reducing your cost of capital in that first phase is really important. And then you can have refinancing for the operation phase that would actually limit interest rates and also allow for a better view of what is the risk for the investors. So now I would like to move to our panelists once again. So the first question, and basically we'll address with you three, improving access to finance, improving the pipeline. The first question is addressed to Megumi. So there are good examples actually in Kenya related to addressing limited and underdeveloped distribution channels for the clean cooking sectors. Could you please share with us some of these success factors?
Yes. So in Kenya, the clean cooking subsector is constrained by limited and underdeveloped distribution channels for both cook stoves and efficient fuels. This makes it really challenging for distributors and retailers in providing a reliable supply of clean cook stoves and fuels to customers, especially in rural and remote areas. To address the limited and underdeveloped distribution channels in Kenya, without having to develop a new distribution network, there are manufacturers and distributors that are relying on existing distribution networks previously used for another purpose and local partners, and repurposing it to sell improved cook stoves and efficient fuels. So for example, Raj Ushanga House, operational since 1980 in Kenya, is a leading importer and distributor of high-grade decorative glass beads. It has a very well-established distribution network serving off-grid areas. And in 2012, looking to leverage its well-existing distribution network. It repurposed its distribution network to sell renewable energy products and signed an agreement with Azuri Technologies, which is a leading private sector player selling solar home kits, to distribute pay-as-you-go solar home systems. And today it is the largest distributor for Azuri Technologies in Kenya. Another similar example is 1 Acre Fund, which is an NGO in Kenya providing agricultural and non-agricultural products and services to its rural farmers through asset-based lending. And this organization aims to tackle rural poverty by offering a complete bundle of services, such as financing for seed and fertilizer, distribution of farm inputs, and training on agricultural techniques, among others. The 1 Acre Fund delivers input to a number of rural sites that are located just within walking distance of every farmer served. And leveraging this approach in 2011 and using its existing distribution network, 1 Acre Fund started offering cost-saving solar products such as solar lamps and clean cook stoves as an optional add-on to its loan package. These are some good examples of how the issue of the lack of distribution channel can be addressed to achieve a scale that is needed. Okay. Thank you.
Thank you very much, Megumi. That was very interesting. Now I would like to move back to you, Stan. I think this is a similar topic, but addressed from the commercial bank perspective. Could you tell us what has been done in Ghana from your perspective as Stanbic Ghana to address demand-side challenges?
Okay, so quite a number of things that we pushing to do. It's not at the level that we want it to be now. But basically what I have tried to do, especially in my bank, because I'm the head of product as well, we try to look at the business as usual type of product. So you are looking at things like mortgages, things like energy demand, people who either to buy generators and all that. So we look at the product and say, okay, how do we convert this into a green product? So for instance, our mortgages, we are re-looking at it and we have started green projects where we've worked closely with IFC-H to say, put in place more of green buildings instead of the old ways of building. So what we also plan to do is to price some of these products to be cheaper than the business as usual type of products. We are looking also at the vehicle and asset financing space, and also looking, we have already had approval for all personal loan facilities that are targeted at buying home appliances. So most of the people who are workers, teachers, military people and all that. You see them buying some air conditioner, some television and all that. How do we make sure that instead of going for just any air conditioner, we are getting them to get like green cooling systems? We've worked closely with Energy Commission and then GIZ that are driving the green cooling initiative across Africa to make sure that people are demanding for some of these solutions that benefits all of us rather than just going in for anything. So what we have done is to align our products to become more sustainable or green. So it gradually becomes business as usual for the clients. So our target is to make sure in the next few years, maybe in the matter of 3, 4, 5 years, we should be able to say maybe 70% of our products are green. We know that there will still continue to be some vehicles with that will need fossil fuel in the system, which will phase out gradually. But that is what we are doing. We are putting together products that are very sensitive to the SDGs and climate change to make sure that they are largely green, to make sure they are also much cheaper for the demand side of things. Thank you.
Thank you very much, Tan. And this is great to hear that you have such objectives in Ghana, and we hope really that you'll be able to achieve those. Now moving on to Alexandra and well, thinking of time, linking the demand and supply is really critical, and we know that UNDP through the NDC support program has provided capacity building for the private sector to utilize a platform for project aggregation and standardization. Could you please give us a quick background about this?
Yeah, thank you, Samuel. To increase the interest of investors in projects, we see the need for standardization of smaller projects so that they can be analyzed through the same lens, compared and have the same metrics. And we also see the need for aggregation so that projects can be pooled for investors to address the issue of investment size. And for this to happen, companies need robust tools and innovative platforms such as the Odyssey platform, with which we worked and provided capacity building for companies to use this platform. These platforms offer technical and financial tools which can help developing, financing, and managing distributed energy systems at scale. And through these platforms, financial reports can be developed, technical analysis done, visualization and live system data feeds imported and analyzed to help standardize projects and prepare them for deal assessments by investors. We have done this in Uganda, but it would be interesting to hear from Stan if he sees a potential for such platforms also in Ghana, which could then help to overcome the access to finance barriers. Over to you, Stan.
Yeah, definitely. I think that one of the major problems that most institutions, and I can largely talk for the banks, have is the fact of the skills, the capacity to evaluate some of these projects and quickly sanction them or attract funding for its finance. So if we have these platforms that have some of these projects standardized, analyzed, technical assistance provided, I think for me it will be a very fantastic way of driving and helping the financial institutions, especially the banks, quickly mainstream and entrench the finance of these projects into their domain. So I think that will be very, very fantastic. It's something that I would like to look at later today.
Great, excellent. Thank you so much, Stan.
All right, okay.
Okay, thank you very much, Alex and Stan. It was very interesting. I'll try to go very fast through the last slides so we have enough time for the questions and for the Q&A. But again, I've looked through your questions and I know that some of the slides already answered them. So I'll try to get some balance here. So the next topic is actually related to innovation. What we have tried to illustrate here is that there are solutions both for the supply side and for the demand side. So on the demand side, what is really important for innovation is to increase the pipeline of projects investable. So this can be done by building the ecosystem, by providing more acceleration services, by increasing the number of enterprises investable. One example of such work is actually in Kenya. This is the Kenya Climate Innovation Center, which provides a holistic solution to the pipeline issue. It works on incubation services, on acceleration services, and on financing through its VC branch. So you have this focus really on climate only. Another example is the work of Acumen with the Green Climate Fund. So Acumen has developed this impact investment fund in East Africa, which provides investment to the energy sector in off-grid investments. So this is combined with others LP equity investment, and this allows Acumen to invest in some of very innovative and very well-known startups such as Bbox, for example. So moving on to the next topic, which is, no, this is before this. Yes, no. Okay, which is moving to, thank you, Raymond. So the next topic is related to access to finance for smallholders, which is, very important in all the three sectors. Here we have outlined three solutions. We have discussed those during this webinar actually already, so I'll be very fast. But basically we have discussed leasing, we have discussed asset-based lending. What we have not discussed are corporate PPAs and equivalent. We have not much time, but basically the idea is that those provide solutions to the financial sector to avoid requiring collateral, and to the demand side, they provide end users with a solution to not have to cover initial costs. So those are very important solutions, which we don't have time to cover right now, but we can cover those during the Q&A if you'd like more information. And moving on to the final topic today, and this has been touched upon in the previous slides, and I've seen some questions related to this. So this is encouraging the mainstreaming of green financing, and Stan has mentioned that having a green taxonomy is extremely important, and we also think so. So this can be pushed from, of course, a regulatory perspective. And that can support the identification of which activities actually qualify as sustainable, and you would actually avoid things such as greenwashing. This has been done very recently in the EU. Even in the EU, this is 2020, and the EU taxonomy of sustainable finance. And by the end of 2021, the EU is going to request that investors that offer funds described as environmentally sustainable explain how they are actually sustainable and how they are aligned with the taxonomy. So in the Philippines and Paraguay, you have guidelines related to sustainable finance that could actually be a good start for this. But we see also that move in Ghana, as outlined by Stan. So that is extremely important, and that could also help to actually encourage the development of a green bond market, which would be extremely important for infrastructure development. And with that, I will stop to leave us some time for the Q&A and give back the floor back to Taha. Thank you very much.
Yes, thank you. Thank you, Samuel. Thank you, Raymond, Alexandra, Stan, Megumi, for all your contribution. The floor is for Richemont Assis from Côte d'Ivoire to ask his question. Thank you.
Thank you very much, Taha, for this opportunity to discuss on this issue, critical issue. What I would like to ask is just firstly to raise an issue about how to explain clearly to the private sector what can be considered as green project, directly green project, or what can't be considered as green project. We are facing some challenges here in country, in Côte d'Ivoire. It's about a dam, yes, a very big hydroelectric dam here in country, and some partners related to energy sectors say that this is green if we add some related projects like reforestation, like maybe some projects with villagers and rural communities and so on. This is a very big issues we are facing here, and how to convince those stakeholders that some projects can't be considered as green, even if we have some green aspect inside and so on. This is just a very question. Thank you.
Raymond, do you want me to take that one, or?
Yeah, yes, please go ahead, Samuel.
Sure. Thank you, Richmond. It's very nice to hear from you and to hear that question. Yes, this is a very important question. I would encourage you to look at what the EU has done on the EU taxonomy. They have done some really amazing work on this, meaning that you actually have definitions of what can be considered a green asset and what cannot be considered as a green asset. What would be activities that are actually excluding an asset from being considered as a green investment. So I would encourage you to look at this, and probably the next step for the country, if I'm not wrong, this is Côte d'Ivoire, would be to look into how to have similar regulations in the country to to avoid that kind of greenwashing and make sure that investments are aligned with the regulations that tell you what kind of investments are sustainable, what kind of investment are not.
Probably just to add and to supplement to what Samuel answered to that, it would basically be public and policy driven in a way that you need to have that standardized definition of green financing, and not just look into, for example, just from a single project perspective, as you mentioned, for example, from a large hydro power project. So at least the definition of or the taxonomy should come from the policy side, in defining which particular projects are green and which could be considered as or eligible as part of that definition.
Maybe I can also add a few words. I mean, hydropower is by definition renewable energy, so per se it is a green project. But of course, some sizes of hydropower plants involve more risk. So large-scale hydro is definitely more risky than small hydropower plants. But there is also guidelines that were developed by the World Commission by the World Commission on Dams. Yeah? So there are plenty of reports and standards and guidelines available, and there are also ways to overcome this risk and address the risks. So you can look into these guidelines developed by the World Commission on Dams to ensure that also, for example, rural communities are not, or that mitigation measures are taken to address the impacts on rural communities through large-scale hydropower. Yeah, over.
Yes, I will hand over to Verenia Chow to ask her question, please.
Thank you. Hi, everyone. Good morning, afternoon, evening. Yeah, I have a question in relation to the example of Kenya, but maybe there are other countries that have also thought of this. I would like to know what has been the role of women's groups in engaging or supporting in the distribution networks, particularly in the rural areas, and if there is any investment in training, in building leadership and organizational capacities within these groups in different countries. Thank you.
Yes, thank you very much for raising that question. Let me take this. Let me answer the question on our behalf for this one. In fact, when we talk about looking into the accessing the finance or access to finance. The focus of the study is basically on, the barriers, the limitations in accessing these finance. So in terms of looking at the gender side, or the gender aspect or social inclusiveness, that was not really or at least an in-depth analysis or in-depth assessment of that was not included as part of the scope of what we had to do. But I think that could be that's a very, very interesting question that you raise, and probably could be addressed by other projects in the future. But what do you think, Alex?
Yes, no, UNDP has done an extensive gender analysis in Kenya, and Verania is actually the right person to talk about it, because she spearheaded the work on gender in Kenya. So this impacts on recommendations and suggestions to engage women in NDC implementation, and energy is definitely one of the key energy sectors, has been considered and addressed in this gender analysis, and we have done provided several recommendations to the government and regional governments to ensure that that gender issues are fully addressed. Yeah.
Yes, thank you, Alex and Raymond, for the answers. Next question from Aniko Polo Apiso, please.
Thank you so much. I am very grateful for being part of this webinar, and I thank all the presenters. My questions are directed to Mr. Stan from Ghana, because I can salute their activities, and I would like to know if there is an existing national framework that guides or facilitates or allow their activities, or if they get some kind of incentive from the government for what they are doing. This is my questions. Thank you.
Yeah, so I do quite a lot of work with government. It might interest you to know that I work on the nationally determined contribution National Determined Contribution Committee, which is the NDC for climate change. So I can talk for myself and my bank as individual and a bank that we work very closely. My bank and my CE as well have been part of some of the initiatives to support government implement the SDGs. So there is some level of collaborations that I can comfortably say is going on, but I would have loved to see more. I don't think that the framework as we have it now is enough. That is why I am calling for things like form of a green taxonomy for the country that will actually tell what sort of funding, for instance, that somebody asks, we are calling green, what sort of funding are we targeting from the to be funded by financial institutions that the central bank can also support and all that. I mean, already we are doing some work with the central bank, but I think there's a lot more to classify these initiatives so well that people are comfortable to take part in the implementation or mainstreaming into their organizations. Thank you.
Yes, sorry, colleagues, we're running out of time. All questions will be answered by written in the transcription that will be put online in the few days. Presentation and recording will be available on the link shared in the chat box at the end of in few hours at the end of the day. Thank you very much to all of you, and we stay in touch. Bye-bye.
Bye.
Thank you very much, everyone.
Thank you, everyone. Bye.
Thank you very much.
Bye.
Bye. Ciao.
Thank you. Bye-bye.
Bye. Hello?
Yeah?
Yes, sorry, thank you. Thank you for the invitation and for the presentation.
Yes, sorry, Mr.
Yes.
Sorry, Mr. Vahan. At the end, they asked to cut everything, but all the questions will be answered. We will take the question from the chat, and it will be answered by mail, by written. And I wanted also to apologize because I have noted your name from the last time that you were waiting in the waiting room, and then maybe we were like a bit late, so you couldn't join us for the first webinar.
I also had connection problems from my end. So,
yeah. Okay. So anyway, yeah. Thank you very much. Bye bye. Bye bye. Okay.